Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rate at the lowest cost, reach out to me. I'd like to meet you, and that is for sure. Here is this week's mortgage market at a glance. There were three distinct parts to this past week. The first part consisted of the entirety of the first 3 days. Rates didn't move much as the market continued to digest the big spike seen at the end of last week. In part two, things got crazy relatively. The week's biggest economic data, the Consumer Price Index, CPI, was released and chaos ensued. CPI is one of the two most important broad inflation metrics, and inflation is one of the most important considerations for financial markets right now due to its implications for the rapidly evolving Fed policy outlook. The median forecast among economists called for a fairly big increase to CPI, with the more important core component, which excludes food and energy, rising from 5.5% to 5.9% in January. Traders felt this number was a bit too high and were hoping to see something under 5.9%. That likely would have allayed fears that the Fed would hike rates by 0.5% in March as it finally moves up from 0% lower boundary. CPI did not come in under 5.9. It actually came in at 0.1% higher at 6%, which is the highest number in decades. Now, following the Fed data, Fed Fund futures for April, which is the market's way of betting on Fed rate hikes, quickly moved to price in a 0.5% hike. The probability increased to over 90% from roughly 50% the day before. It's worth noting that part of the motivation came from comments from St. Louis Fed President James Bullard. His comments earlier that same afternoon. Bullard took a widely more aggressive stance than any of his colleagues, saying he'd like to see a total of 1% of a rate hike by July 1st, roughly double the consensus. While Bullard received a lot of flack from market watchers as being responsible for undue drama, it was the CPI data that did most of the damage. Well before Bullard's comments, CPI pushed the 10-year treasury yields up from the important 2% technical level, a psychological boundary that, if broken, stood a chance to prompt more weakness in bonds. Moreover, anytime such a technical level is broken, there's a risk it will act as an inflection point, which is why key levels are often referred to as pivot points. That blocks the future progress back toward lower rates. Yields did indeed break above 2% and nearly hit 2.03 before we ever heard from Bullard. Markets emphasized the importance of the 2% barrier the following morning as they refused to break back below, despite the weakest consumer sentiment reading in more than a decade. This made a bad situation worse for mortgage rates as the average 30-year fix had just crested 4% for the first time since May 2019 on Thursday. Notably, the weekly Freddie Mac rate survey also came out on Thursday, showing a rate of 3.69%. This was extremely far from reality from the moment it came out for all usual reasons. Be sure to check out some of my past videos for reasons why. The third and final part of the week arrived on Friday afternoon around 1:30. That's when news broke regarding the prospect for a Russian invasion of Ukraine effective immediately. There's been a lot of press coverage over this conflict over the past several months, but this was the first time a headline had this level of impact. PBS defense correspondent Nick Schifrin reported that three officials said, in quote, "The U.S. believes Russian President Vladimir Putin had decided to invade Ukraine and has communicated that decision to Russian military," end quote. And that invasion was expected to begin next week, following 2 days of aerial bombardment and electronic warfare. Whether this happens or not, markets took it seriously. In a few short hours, the entirety of the week's damage was erased as far as treasuries were concerned. Fed funds futures even managed to move almost all the way back to their previous stance on the size of the March rate hike. Unfortunately for mortgage rates, the Treasury market is a bigger beneficiary of market panic when it comes to geopolitical risks. In other words, mortgage rates were not so quick to retrace this week's steps. It would be hard to visualize that when looking at a short-term chart of mortgage rates themselves, because they are only updated a few times a day, even on volatile days. Instead, I can chart the rate implied by mortgage-backed securities, which is what mortgage lenders use to determine rates anyway. So, long story short, even after the bond market bounced back on Friday afternoon, MBS's, mortgage-backed securities, were only a fraction of the way back to levels from earlier in the week. As a result, mortgage rates remain just over 4% on average, despite falling from higher levels seen on Friday morning. Now, keep in mind, all references to mortgage rates are for broad averages among multiple lenders and not reflective of what I may be able to offer you. There is a high degree of stratification between lenders and loan programs at the moment. This week brings several economic reports that have been important at times in the past. Chief among these is the retail sales data on Wednesday morning. That said, rates are preoccupied with the Fed policy outlook, and none of this week's reports will be remotely as important as CPI was. In fact, many traders are already talking about the next CPI report in early March, as it falls just 1 week before the Fed's next big policy meeting. In the meantime, any significant escalation in Ukraine could put additional downward pressure on rates and yields, but the mortgage market would suffer from the same underperformance issues seen on Friday. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, and that is for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.